Okay, so let's talk about options. You've probably heard the word thrown around, and yeah, it can sound pretty complicated, right? You hear stuff like calls and puts and all this other jargon, and it's easy to just tune out. But what if I told you the basic idea is actually super simple? So simple, in fact, that we can explain it using a collector's item. In this explanation, we're going to peel back all those confusing layers. We'll get right to the heart of what options are, how they really work, and why they can be so powerful for both incredible gains and, yes, big losses. So you ready? Let's dive in.
All right, here's our roadmap. We're going to start with that simple analogy I mentioned, just to get the main idea down. Then we'll get into the two main flavors of options, calls and puts. After that, we'll break down the key pieces of an options contract. Then, the fun part. We'll see how the money is made, or lost, with a real example. And we'll wrap up with a really important look at risk versus reward.
So, first up, let's make this whole thing feel a little more familiar. Before we even touch the stock market, we're going to start with a story, an analogy. This is going to make everything else click into place, I promise.
So let me ask you this. Just imagine for a second. You find something you think is going to be worth a ton of money soon. But maybe you don't have all the cash to buy it right now. Or maybe you're just not 100% sure yet. What if you could pay a small fee, just a little bit of money, to guarantee yourself the right to buy it at today's price, but like a month from now? That gives you time to see what happens, right? Well, that exact idea, that's the core of what an option is.
Okay, so here's our analogy. Let's say you see this really cool collectible, and it's selling for $100. You've got a gut feeling it's about to become super popular. Instead of shelling out the full $100, you go to the seller and say, hey, I'll give you $5 right now if you promise to sell this to me for $100 anytime in the next month. The seller agrees. Now here's the magic part. You have bought the right to buy it for $100, but you have absolutely no obligation to do so. If that collectible suddenly becomes the hottest thing and is now worth $500, you can still buy it for your locked-in price of $100. Awesome, right? But what if it turns out to be a dud and the price crashes to $10? No problem. You're not forced to buy it. You just walk away. The only thing you lost was your $5 fee. That $5, it bought you the choice. It bought you the option.
All right, now that we've got that basic idea of buying a choice, let's meet the two stars of the show in the options world, calls and puts. You can think of them as two sides of the very same coin. Each one represents a totally different belief about where you think the price of something is going to go.
And here it is, the formal textbook definition. Yeah, it's a bit of a mouthful, but I want you to look at it and find those magic words we just talked about. The right, but not the obligation. That is the phrase you need to burn into your brain. Everything else is just detail. Just like with our collectible, you are paying for flexibility. You're paying for the freedom to choose, and that freedom is the entire game.
So how do we tell them apart? It's actually really simple. A call option gives you the right to buy something. You'd buy a call when you're feeling bullish, when you think the price of a stock is going to go up. You know our collectible story? That was a perfect example of a call option. Now, a put option is the total opposite. It gives you the right to sell. You'd use a put when you're feeling bearish, when you believe the price is heading down. That's really it. Just remember, calls for up, puts for down.
And hey, don't just take my word for it. Here's a quote directly from the official source material. It puts it as plainly as possible. An option that gives the right to buy is a call option, and an option that gives the right to sell is a put option. See? No hidden complexity there. It's a simple distinction, but believe me, it is the foundation for absolutely everything else we're about to cover.
Okay, so every single option is basically a mini contract. And just like any contract, it has some key terms you gotta know. So let's zoom in a little bit and break down the three most essential pieces of the puzzle.
First up, we have the exercise price, which you'll more commonly hear called the strike price. This is just the fancy term for that locked-in price we keep talking about. Remember in our analogy, the $100? That was our strike price. It's the price we had the right to buy the collectible for, no matter what its price did in the open market. For a call, it's the price you get to buy at. For a put, it's the price you get to sell at. Simple as that.
Next up is the premium. This one's super easy. The premium is simply the cost of the option contract itself. Remember that $5 non-refundable fee we paid for our collectible choice? That was the premium. Now, in the real world, this price is always changing based on things like the stock's current price, how much time is left, and a few other factors. But at its core, the premium is just the price tag for buying that right to choose.
And finally, we have the expiration date. And folks, this one is absolutely critical. Options do not last forever. They have a shelf life. In our story, our right to buy the collectible only lasted for 1 month. The second that month was over, our right, it just vanished, poof, gone. This is why I'll often hear people call options wasting assets, because every single day that passes,
a tiny piece of its value, which is called time value, melts away, like an ice cube on a hot day. That ticking clock is a massive part of options trading.
All right, this is where it all comes together. This is where the rubber meets the road. We now know what an option is, we know the difference between calls and puts, and we know the key terms of the contract. So now let's look at how this all translates into actual dollars and cents. Let's see how the payoff works.
So let's paint a picture. Let's say you've got $5,000 set aside, ready to invest. You've been watching this company, we'll call it XYZ stock, and it's currently trading at $50 a share. And you've done your research, you've got a good feeling. You are bullish. You think the price is going to go up. So now you have a choice to make. Do you use your $5,000 to buy the stock itself? Or do you use it to buy call options on that stock?
So check out this table. It lays out the two different paths. Investor A is straightforward. They take their $5,000 and buy 100 shares of the stock. Investor C takes that same $5,000 and buys call options instead. Now, watch what happens. Let's say you were right, and the stock price shoots up to $62. Investor A, who bought the stock, made a nice $1,200 profit. That's a solid 24% return. Not bad. But Investor C? Whoa, they made $7,000. That's a 140% return on the same amount of money. What you're seeing here is the power of leverage. It's using a smaller amount of money to control a much larger value of stock. But, and this is a huge but, leverage is a double-edged sword. Look down at the bottom of the table. If the stock price just stays flat at $50, Investor A breaks even. No harm, no foul. But Investor C, they lose everything. Their entire $5,000 investment is gone, wiped out, because their options expired with no value.
Let's just pause and stare at this number for a second. 140%. This right here is what gets people so excited about options. It's the potential for these kinds of amplified returns. When you're right about the direction a stock is moving, options can magnify your gains in a way that just buying the stock often can't.
And if the numbers on the table weren't clear enough, this bar chart just screams it at you. Look at the difference. The blue bar, that's the profit from buying the stock. The orange bar is the profit from the options. It's not even a contest, right? For the exact same $5,000 investment, the option strategy in this winning scenario delivered a profit that was almost 6 times bigger. That, my friends, is leverage in action.
Okay, we've seen the fun part. We've seen the massive gains and the crazy percentages, but no one should ever talk about options without having a very serious, very honest conversation about risk. So let's talk about the other side of that coin, because understanding the complete picture is absolutely non-negotiable.
This quote from the source material says it all. It gets right to the terrifying heart of it. You can lose the entire amount you paid for an option. That premium you pay, that's the most you can possibly lose as an option buyer. But losing 100% of it is a very, very real possibility. And remember that term we used earlier, wasting asset? This is where it really bites. Every single day, that clock is ticking, and your option is marching steadily towards becoming worthless at expiration.
And this number, this is the one that should make you sit up and pay attention. Negative 100%, a total loss. Going back to our example, this was the harsh reality for Investor C if the stock didn't move up or didn't move up enough by the expiration date. It wasn't a small loss, it wasn't down a little bit, it was a complete wipeout. The entire $5,000 just gone. That's the brutal reality of leverage. It can create incredible wins, but it can also create catastrophic losses.
So, let's wrap this all up. What are the absolute must-know takeaways from today? Number 1, options give you the right, not the obligation. Say it with me. Number 2, calls are your tool when you think the price is going up, puts are for when you think it's going down. 3, options give you leverage, which is a powerful force that can amplify both your profits and your losses. And finally, number 4, and please never ever forget this, as an option buyer, you can lose 100% of the money you put in.
So when you boil it all down, options are really about 3 things: the power to choose, a price you have to pay for that power, and a ticking clock that's always running out. What we've done here is just scratch the surface, just lay down the absolute fundamentals. But now, with this foundation, you're equipped to start exploring the much, much bigger world of options with a clear head. So the only real question left is, what's your next step in learning? Thanks so much for joining me for this explainer.